Hi, this is Randy Finney with Right Side of the Chart, and this is a midday update for Wednesday, September 18th, 2019. It is a little after 11 o'clock Eastern Time as I'm starting the video. Just one more reminder, today is the FOMC announcement at 2 p.m. Eastern Time. So what you can expect from there is some volatility immediately after the decision, and that noise, I'll call it, will start to abate, or should start to abate, later this week, and possibly going into the weekend. We'll see. We'll see what the market does. I'm just going to start out here very quickly with the long-term chart. That's something to me very important. I don't cover them in every video because you don't have a lot of changes. This is a monthly chart. Nothing significant happens on this chart until the month is over, and today's only the 18th, so we have a couple weeks to go. But just bigger picture stuff. And again, you can see, SPY. I have the S&P 500 breaking its bull market trend line, whereas the tech-heavy NASDAQ 100, I'll show you various trend lines, but either way, we have a breakdown, but we're still above that 20-month moving average, and you have this trend line here. This comes off the lows on December 24th right there, and that's a level to watch. So again, just see, this chart isn't going to change today, but it has the potential to change by the end of the month. And while the trend remains bullish, you can see these divergences. To me, they're not to be ignored. I know, some people dismiss them, and there is a possibility they burn through. But, we're going back here decades, literally into the 80s, and you can see you don't often get negative divergence on the monthly time frame. In just about every instance you had, as they're marked here, you've had bear markets or near bear markets. 20% drop, 51, 57, 15, 20 so far, but that's what I consider the shot across the bow, most likely because we continue to extend the divergences. So there it is. And again, levels to watch. And the point is here, if nothing else, here's right, we're at the top of that candle now. From where we're at today, that's only about 7%. And if we come in next, let's see, depending how this monthly candle closes, we'll call it, a little bit over 7% to that key 20-month EMA right there. QQQ, similar story. Here's the trend line that I have on QQQ on my monthly chart. Comes off the 2008 lows. Remember, the NASDAQ 100 is the only index that bottomed in the tech sector back in November of 2008. That's when their bear market ended, technically speaking, whereas everything else, S&P, small caps, just about every other sector you have was March of 09. So either way, you come in and capture both of those candles, get the body on that March candle, the end of the tail there, or the bottom of the tail on November, and then you can see a lot of nice clean reactions as we go. So this is a key uptrend line. That was a whipsaw signal there. Oh no, I'm sorry, we closed back above. It's a green candle. That means we closed the month back above there. This one essentially right on there. So you've got both the bull market uptrend line, and then just south of that is the key 20-month EMA. And so again, levels to watch. Maybe we wedge higher, maybe we continue to do this. Anything's possible. Maybe we burn through these divergences, but I really, really doubt that, just based on the posture of these charts. So like I said, I think the upside's minimal. And then finally, small cap traders, draw a couple trend lines here. The IWM, the small caps topped way back in 2018. They're well below their highs, unlike the large caps. And so here's a trend line to watch as well, which again, we're sitting precariously on that trend line. We've been testing it, and that comes off the lows as well. Had a little overshoot there, but comes in right around the body of that March candle, March 09. So there's your, call it the benefit of the doubt, last chance uptrend line on the small caps, which are already kind of trading through their 20-month EMA right there lately. Part of this, the small caps are only going to go down so far without the large caps following. That's why. So you had a top in the small caps, healthy correction, or technically speaking, a bear market if you want to look at it that way, a drop of 25%. But they're not going to drop 50% with the large caps at all-time highs. So they're kind of holding up in a holding pattern here. And again, once that level goes, you can see the next target down here is about 129 or so. All right, now let's jump all the way fast forward to the 60-minute charts. IWM broke down recently, highlighted here. We had a price channel breakdown, flirting with this 156.53 support, cracking a little bit below it today. Again, it's an FOMC day, so you have to take any breakdowns that occur right before the FOMC meeting with a grain of salt. But I did say yesterday too, when we go to the let me find my RTY chart for the futures traders. In the charts I'm watching, I put up in the morning. Here we go. Said a break of this trend line here would trigger a sell signal. We dropped, fell, bounced back up, made a perfect back test. That gave you a second opportunity to get short. And so far, nice trade on the small caps. If you trade RTY, that's a drop of about 1%. From that short entry yesterday. So you had two opportunities, the breakdown or the back test. And now we're at support, so you can see it about 115.68 or so. Previous reaction low. I modified that line. So actually that was the September's. When I posted it yesterday, they've rolled now to the December futures, so your price levels are going to be a little bit different. But I still maintain the same price target, and that is down here in this zone right here. About now it's 1548 to about 1553 or so, and then I think ultimately we work our way down to 1528. If the large caps play that scenario that I showed you with the head and shoulders pattern on the NQ futures, or potential head and shoulders and a pop to a marginal new high, if that plays out, and I would almost have to put about 50-50 odds if it does, you're talking the same story here, a marginal new high. I can easily see it in the charts because we would still have, we had a divergent high right here when small caps peaked. If we have a marginal new high now, it will only put in larger divergences. It would look something like this, and that would be to me, a great shorting op if we get it. So I'm kind of going a little light into the Fed. I'm carrying a little bit of short exposure. I still have core swing shorts, and they're hardly underwater from where they were entered back almost 2 months ago or so. And again, so I'm going to hold off on those active trading stuff. We'll see what happens with the Fed today. I'm giving you levels. You'll just have to react. If it goes this way, again, anything that happens before 2 p.m. today, even right after 2 p.m., take it with a grain of salt. But these are technical levels, and they're worth watching or trading off of if you get that. So like I said, I would almost certainly be adding to an RTY short if I decide to take it into the FOMC meeting. In fact, I might just cover right now because we're probably going to bounce today off this level here before the meeting. So let me pause the video and let me do that right now. Okay, yeah, I reversed RTY from short to long. Again, because we're at support, you can see that previous reaction low. There's some reactions there. You have the, NQ at support. I'm going to get to that. Here, I'll jump to NQ right now and show you. It all kind of goes in together. All right, NQ, NASDAQ 100 futures. Here we go. All right, so the scenario that I laid out last night, and it's just, we'll see. We need to have that right shoulder. It'd be nice to see it formed a little bit better. That's the left shoulder. I'll draw it out for you here. Head and shoulders topping pattern, which has a left shoulder, a head, a right shoulder. Now there's already a right shoulder there. Like I said, if we come and make a back test, that would look something up here. Back test the trend line. Really want to keep it down below the top of the head, although it's an upward sloping neckline, so you could have a higher right shoulder here. Or maybe that's it. You don't have to have perfect symmetry. So again, whether we get a post FOMC pop, if we do, any test to that trend line would be an objective. Or you may not get that. Like I said, certain we already broke down. So from this alone, back out the FOMC meeting, back out any uncertainty. There's always uncertainty in the market, but a little bit more with the FOMC. This is a breakdown and a back test so far. And we're still below trend. We're below that trend line. So that's that. You could probably even draw a trend line off the highs. Again, levels to watch and see if you get reactions off these today. There it is. There's your downtrend off the highs. Let me add this to my chart now. I like that trend line. Let me throw it up here. Put it right there. Clean it up a little. There we go. All right. I want to watch that trend line because that could give us a, you pop that trend line and that would be, could be the catalyst for a rally up. And you know what, I think this probably happened today at some point. Let me check. We're at support. Yeah, here we go. Let me just zoom in here. kind of talking to myself because I'm thinking about going long NQ right here. Yeah, we're at support. Remember yesterday's video I showed you we had a late day technical breakout. You had resistance here and you popped above it and had a little rally right there on that big green candle. And so we pulled back to that support level now and we're kind of pinching there. So that would be, if you're an active trader, day trader, you might get an op here. You can go long right off this support or on a breakout there, probably target up there to about that 79.26 level. And before the FOMC meeting possibly. And then after the FOMC meeting, if you get this, that would be a good place to sell that if you have the gumption to go in long or short in the FOMC meeting. If you don't want to take a lot of risk, you close things out, see what happens, and then jump on, for an example, an objective shorting op or maybe a breakdown there, a break of the head and shoulders pattern too. Anything that happens today will run a higher risk of being a whipsaw signal, but like I say, I do these videos. If you have traderitis and you just feel you want to be trading all the time, be trading today, then these are levels to watch. Otherwise, sit back and let the dust settle after today, and then see if once all that post-FOMC noise is abated, then you can maybe jump in if we start to see something set up. Like maybe we form that right shoulder and we come down here and we start testing that trend line there, then you wait for a break to be your next sell signal. That's one example. Okay, and here's QQQ. You have that uptrend line that comes off the late August, it was August 23rd lows right there. And there's that BOD trend line. I call it benefit of the doubt. Come in, capture 1, 2, 3, and now 4 reactions there. So this is what it would look like if we do get a pop again with the FOMC meeting, and I'd say pretty decent odds that that'll happen. And then you might have a nice shorting up here because that will have given you this nice clean bearish rising wedge right there. And I like to either short the top of a wedge at the point where I think it's probably the last touch with minimal upside, so you can short there, and or add to that short on a breakdown of the trend line or the wedge, of course. And you can see that should we get that pop, and I'm favoring that. And, hold on a second, let me do one thing here. Okay, all right, so yeah, that's what we'll be looking for. And again, the head and shoulders pattern isn't as clear on QQQ. The neckline's a little steep, a little steeper, I should say, than that on NQ, because you have different trades on NQ, the after hours. But there it is, looks something like that. And so you can see the scenario I have drawn here: pop up, and then a reversal. And then break down. The measured target is just on a head and shoulders. You take the widest part of the, from the head down to the neckline. You add that to where it breaks down, and that's not. I didn't measure it here. I'm just telling you that's rough guide there. You can see some support too. So there's a near-term trading op right there. That'd be a target if you're looking to trade that scenario, or a break of this trend line if you don't get the lift up. About 189 or so is a pretty decent support level on QQQ. So we'll watch that one certainly. And the other things I'm watching, I'm still carrying some longs in the precious metals. Not all of them. Palladium I had shorted recently. That's a hedge to my gold and silver longs. Here's gold broke out today. I posted this. I've been posting this one last couple days. There's that trend line. So we have a breakout in gold. And so far so good. Again, there's always the potential that it's just a whipsaw signal in front of the Fed, but take it on face value. It is a breakout, so you can have some minor resistance right here. These reaction highs, gold needs to clear that. And again, you can look at it as a pure play trade, long trade, or also a hedge to short positions, because if no, that wouldn't work. More of a hedge to long positions. Because if the market drops, stocks go down after the Fed, especially a sharp sell-off, you'll probably see a rally into gold. So this actually right now, I've kind of flipped depending on what the technicals are. The technicals right now to me are bullish with the breakout there. And of course, want to see, this is pretty key support, as I mentioned, about 1492 right there. And let's look at silver. Silver, got down, here we go. Silver already broke out, as mentioned this morning, broke out and back tested. So there's your breakout. Gold hadn't yet broken out. Gold was still at the downtrend line, so silver came in and back tested. Silver is usually only going to go so far without gold, leading the way or following suit. And so it came in for a perfect back test, give you an opportunity again to re-enter. And then gold did break out recently, so you have this little lift here. Again, I don't expect fireworks in front of the Fed, and the breakout could fail, but as of now, it's a breakout. So you can see my targets here. All the way up here, potentially to that 1887-ish level. Pretty decent resistance levels here. Targets to maybe book some partial profits along the way. And like gold, you don't want to see us take out the recent lows. 1492 on gold comes in roughly. It's a little, that low's a little bit up there, but we'll call it about 1740. Pretty good support right there. 1740 on silver futures. If that goes, you can see my next support here about 1694. So as of now, I'm favoring this scenario here. Regardless of any post FOMC noise. Platinum, I skipped over in this morning's charts. It takes a while to get all these charts screenshot and get them out. And I did a lot of feedback from you guys. I know you prefer the charts in the morning, and I'll make a point to do more of that, less in the videos, especially in the morning session. So you can look those over. But there's platinum. Again, I don't think I've changed any of these levels in a while. That 929 or 930 level has been just golden support recently. You can buying pullbacks to that level. Actively trading now. So likewise, support is support until it's broken. If it breaks, and you can see, we'll probably come on down here to that next support at 912. And so ideally, you want to see platinum stay above that level, maybe a downtrend line here, which also gives us that descending triangle pattern. So just like gold and silver, if you get an upside break, that would be a buy signal. Take us up here to probably that target range right there. And palladium, although it doesn't mesh with a rally in the metals, or in gold and silver and platinum, especially platinum. Palladium and platinum are very closely related metals. So therefore, this chart may not play out. Now, we already hit my target. I put this line up this morning, this chart right here. We broke that level, and you can see, technicals work well on these things. This is, we were right here this morning, and so a break of that trend line, I said, would take you down to this target zone, and it happened almost instantaneously. So, you had a shot to certainly get in there, and then the drop. This is a 60-minute chart, so you can see within 1 hour, that red candle, that target was hit. And this is what I call momentum fueled overshoot. We had two, little spikes below, but the candle, that 60-minute candle closed right on the bottom, my 1567 support. Then it held at the next session, and it rallied from there. So it may want to back test. And likewise with the other ones, you can put a downtrend line here. And again, like I said, the bigger picture, and I've talked about this in the past recently, is at the 1600-ish level. It just seems to be a brick wall for palladium recently. You can see, multiple failures at that level, round, give or take 1600-ish. We've made a couple series of higher highs so far, but again, we're stalling out right, at about 1610 or so, and we've stalled out so far. And again, it's these divergences that we have here that haven't yet played out for a correction recently, like we did already have in gold and silver and even platinum. So right there, off the September highs, pretty nice drop in all the other precious metals, except palladium, which I've just jumped back to. That was the same early September highs right there, whereas gold, silver, and platinum corrected. Palladium pushed higher, so kind of a little disconnect there, if you will, between those metals. And the other, pure play longs or hedges to, any positions, equity positions, are these Treasury bonds, and they've ZB is a 30-year bond, so I'll show you TLT in a second. So far we bounced off that 158.053 target, took out the we took out the minor downtrend line there. I showed you that last week or so, and we've rallied since. We took out this alternative secondary downtrend line. Comes in pretty nice. A lot of reactions so far. Broke above that, and so treasuries look good up to at least that 161, 180 target. Here's a trend line, like I said earlier. Might want to use that. Buy pullbacks too. You can run a tight stop somewhat below it. You got to give a little bit of room, allow for a intra period breakdown, but that's CB, and right now that's looking pretty good. The Treasury bonds, and I also ZN, the shorter term. CB is the 30-year bond. ZN is the 10-year Treasury bond. You have a comparable uptrend line right there to watch or trade off of. Downtrend line right there, minor trend line was taken out. So, these continue to rally leading up to the Fed, and so this is either many things, like flight to safety, institutions moving money, some individuals, but usually it's institutional traders doing the Treasury bonds, moving money out of stocks into bonds, hedging, covering their bets, or also a bet that we had a nice pullback in rates, and maybe we're going to see or a rise in rates. Remember, when rates go up, bonds fall. So that was what that was. We had an uptick in rates. In fact, I was reading an article just the other day that the Fed had to come in for the first time in a long time, and they had to shore up one of the Fed banks. I think the Federal Reserve Bank of New York had to shore up do 30 billion in purchases because there was some risk that the money market fund rates would break. They lost control of their federal funds target rate, which is, I think it's two to 2.25 right now is the target rate, and that rate had hit as high as almost 5%. So just quirky things going on in the financial markets right now. So they had to step in and intervene and try to push down that target rate. And that hasn't happened in a while. So a lot of stuff going on right now. And again, these markets, I think it's just a ticking time bomb in my opinion. And so I do these videos. This is all near-term stuff, but don't forget, if we start breaking sports on the daily charts, especially the weekly charts, I'm still looking for another 30+% downside in this market. And when the floodgates break, it's going to happen quick. Whether it happens again this week, next week, next month, somewhere between now and a year from now, most certainly, but we'll see. All right, let's look at one more thing, and that would be nat gas. All right, I posted an update. So if you're watching the video, you probably saw that update. We broke both the two 639 support as well as a trend line. But as I said in that video, the low of the day was chart. Low of the day so far was 629, and I said the next objective sell signal will come on a break anything below that level. I think if we take that out, that's today's lows. It was earlier when I put out that post. We still haven't taken it out, and that's, you can see nat gas is fighting to hold that level now. And if so, why? Well, one thing is we had a previous reaction low right there, and so it's trying to hold that low. But I think anything much below that will solidify the breakdown, and that should open the door for a fairly impulsive move down to my first target there, to 533, followed by reaction, and then a move down to that 469 target. And I give you guys this comparable levels on DGAS. Sometimes you have to adjust. If you're trading DGAS, you might want to keep an eye on nat gas futures. Because that's what this is tracking, and they don't do a perfect job. It does a decent job, but not perfect. So, same thing holds true in reverse. We made a backfill the gap, which is resistance. On DGAS. Remember, there's the gap. The gap would be, that's where we closed. Right, we're about where I have that line, and it's not by coincidence. We've hit that level, and we've been holding there. So sometimes you get a case of the tail wagging the dog, meaning the dog is natural gas futures. That's what DGAS is going in. But there's so many retail traders out there, and a lot of retail traders aren't comfortable. They don't like options or futures. They don't know how to trade them. They don't. Maybe they don't have the capital to trade them, and because you can buy much smaller quantities of DGAS. You can buy one share if you want. So for $92 or $93, you can have a trade which is 300% leveraged on natural gas, where you can't do that in futures. Each NG futures contract is about it's got about $40,000. It represents, so it might be a little rich for some traders' blood. Now, so here's the point. You can see it's not coincidence that DGAS has made a gap backfill. The top of a gap is natural resistance, and so that's all we need to do is punch up a little more, and then DGAS will have broken out of resistance. And maybe if you bring in a bunch of buyers to DGAS, that translates into buying futures, because the CTN then has to, more money starts flowing inflows into these ETFs. They have to then hedge up appropriately with the futures. So again, that's why it could be a case of the tail wagging the dog, and that's why I like to watch both charts when trading these. And you can see, that's the first target there. You can target levels right there. This one, this one I'll leave at, and I always set the targets a little below the actual resistance level. 104.41 is the actual resistance line right there. So I've set that one about 5 cents shy. That level, I'm doing my best to correlate where it comes in on nat gas futures. I have it at the line at 115.27. And so I'm, 7 cents shy, adjusted the target down, below. Really should look like that, but that's that. All right, guys, let's wrap it up here. Yeah, let's just wait and see what happens after the Fed. And of course, I will certainly get some posts out, charts, videos after the Fed's out of the way. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.